Chapter 2, Partnership Taxation. Let's begin with some partnership tax basics. Partnerships are not a legal taxable entity, unlike a corporation. The income and expenses from the partnership flow through to the partner using Form K-1. When a partner gives the partnership property in exchange for an interest in the partnership, it is not a taxable event. No gain or loss is recognized. Again, when a partner contributes property to the partnership in exchange for an ownership interest, no gain or loss is recognized. A partner's basis in the partnership equals the basis of the property that they contributed to the partnership. An exception to this is when the property has a liability that exceeds its basis, which results in a capital gain. For example, property with a $4,000 basis with a $6,000 mortgage attached to it is contributed to a partnership for a 20% interest. Again, $4,000 basis, $6,000 mortgage, 20% basis. You take the $4,000 basis and subtract $4,800 to get an $800 capital gain. So where did we get the $4,800? Well, the partner owed $6,000 on the property. They contributed the property to the partnership 100%. But they aren't relieved of 100% of the debt. They still own a 20% interest in the debt because they own a 20% interest in the partnership. So they were in essence relieved of 80% of the debt, or $4,800, which again is $6,000 times 80%. The partner's basis in the property was $4,000 minus the $4,800 in debt reduction, dropping their basis to zero and then leaving them with an $800 capital gain. The partner is left with a $0 basis in the partnership interest, and the partnership has a $4,000 basis in their newly acquired property, since that was the basis of the partner when it was contributed. What if a partner says, hey, I don't have any property to contribute in exchange for an ownership interest. Instead, I have these services that I can provide in exchange for an interest. Unlike property contributed in exchange for a partnership interest, when you contribute services, it is a taxable event because it is treated the same as compensation. Whatever the percentage of partnership interest the person is getting, multiply that by the fair market value of the partnership. If they're getting a 20% interest and the fair market value of the partnership is $100,000, then they must report taxable income of $20,000, which also becomes their basis in the partnership. What is the partnership's holding period of the asset that they received? A partnership inherits the holding period of the asset contributed. If the property has been owned for 6 months and then contributed, then the partnership's holding period becomes 6 months. Why does that matter? It matters because it affects whether or not it's a short-term or a long-term gain or loss if they sell the asset. One exception is inventory. The holding period of inventory begins when contributed to the partnership. Startup costs for a partnership. Startup costs get the same tax treatment as that of an individual taxpayer. However, syndication fees, such as preparing offering materials, are not deductible, nor can they be amortized. What are the deductions to arrive at partnership income? They are cost of sales, wages, except for partners, don't include wages paid to partners, guaranteed payments, business bad debt, but only for accrual basis partnerships only, interest paid, and interest payments to partners are okay to be deducted. Depreciation, except for Section 179. And amortization of startup costs. And that leaves you partnership income. That was a lot. Let's go through that again. What are the deductions to arrive at partnership income? You subtract cost of sales, wages, which don't include wages to the partners. You subtract guaranteed payments. You subtract business bad debts if they are an accrual basis partnership. You subtract interest paid and interest paid to partners. That's okay. Unlike wages, interest paid to partners is okay. You subtract depreciation, but not 179. And amortization of startup costs. Partnership losses. Partnership losses cannot be taken below basis. Instead, the loss is carried forward until more basis is available. For example, suppose that the beginning basis is $2,400. You add the partnership income of $200. You subtract an ordinary loss of $3,000. Well, that takes you to a $400 loss, but you can't take it. Instead, the $400 loss gets carried forward until more basis is available. Again, $2,400 plus $200 equals $2,600. Then you subtract the $3,000 loss, and it leaves you with negative $400, but you can't take it. You have to carry it forward until more basis is available. I will repeat, partnership losses cannot be taken below basis. Guaranteed payments made to a partner. Guaranteed payments appear in the partner's income during the year in which the partnership's fiscal year closes. For example, suppose a partnership has a May 31st, 2012 fiscal year end. So, the year would be from June 1st, 2011 to May 31st, 2012. Even if the guaranteed payment was received in 2011, it is income on the 2012 tax return because the partnership's fiscal year actually closed in 2012. Partnership self-employment income. You take the percentage share of ordinary partnership income or loss on the partner's K1. Then you add guaranteed payments received and subtract their percentage share of 179 expense. And that equals the self-employment income, which is subject to self-employment tax. What about partnership benefits, such as health and life insurance? These are treated as guaranteed payments and are self-employment income. Let's recap a partner's basis from property contributions once again. When they contribute property, their basis in the partnership is the property's original basis. If they contribute services, their basis in the partnership is the percentage of partnership ownership times the fair market value of the partnership. What if they purchase a partnership interest straight up for cash? Well, the amount of purchase, that's the basis. What are some items not deductible on Schedule A and instead flow through to the partner's K1? foreign tax paid, investment interest expense, 179 expense, and charitable contributions. Foreign tax paid, investment interest expense, 179 expense, and charitable contributions don't go on Schedule A. Instead, they flow through to the partner's K1. What are some items not counted as income on Schedule A and instead flow through to the partner's K1? Passive income, portfolio income, 1231 gains and losses. Again, items not counted as income on Schedule K, but instead flow through to the K1. Passive and portfolio income, 1231 gains and losses. Next is the partnership basis formula. You take the beginning partnership basis, add any capital contributions that the partner made to the partnership. You add their share of ordinary income. Why? Because they pay taxes on it on their personal return. Plus capital gains, plus tax-exempt income. Don't forget that. You include tax-exempt income when calculating the partner's ending partnership basis. How does a partner's partnership basis decrease? Partnership basis is decreased by money distributed, the adjusted basis of property distributed, the partner's share of ordinary losses. Again, remember, losses can reduce basis but not below zero. If the partnership is relieved of a liability, it is considered a distribution and thus reduces the basis. What effect do guaranteed payments have on a partner's basis? No effect. So what is the order of adjustment to partnership basis? Well, first, you increase the basis from the partner's share of all liabilities. Next, you increase the basis from all income items, including, just like we said, tax-exempt income. If you see a problem on the exam and it includes tax-exempt income, don't leave it out because your answer will be wrong. Then you decrease their basis for distributions, then decrease the basis for losses, which again are limited to what? Basis. Keep in mind that gains are always allowed in related party transactions. If a 33% partner sells property to a partnership at a $6,000 gain, then that partner recognizes a $6,000 capital gain on their K1. A 50% or more partner who contributes capital gain property to the partnership, who in return won't use it as capital gain property, they treat that gain as ordinary, and so will the partnership. The partnership's taxable year. The partnership's taxable year must be the same as 50% of the partners, and they must use the same tax year for at least 3 years. A partnership can use the cash basis method of accounting. However, a partnership cannot use cash basis if the partnership has inventory, unless gross receipts are less than $1 million. Then it's okay. They can't use the cash basis if they are a tax shelter. They can't use cash basis if the partnership has a corporation for a partner. And finally, they can't use the cash basis if the partnership gross receipts are $5 million or more, even if they don't carry any inventory. When does a partnership terminate? It terminates when it has less than 2 partners, in other words, 1 person, or when 50% of the partnership interest sells within a 12-month period. It terminates immediately. The sale of a partnership interest results in a capital gain or loss. the amount realized from the sale minus the basis in the partnership equals their gain or loss. So the amount that they received minus the basis, that's the gain or loss. What is the basis again? Their capital account plus the liabilities that they assumed. Any assets sold that are not capital in nature result in an ordinary gain, such as unrealized receivables or appreciated inventory. Partnership distribution in the order of basis reduction. So when a partnership distributes cash or property, this is the order in which basis is reduced. You first reduce a partner's basis by any cash that they received. Then you reduce their basis by the adjusted basis of unrealized receivables and inventory. Finally, reduce their basis by the adjusted basis of any other property that they received. One thing you should note: only money distributions will trigger a gain in a partnership distribution. Do partnerships recognize a gain or loss on a distribution? No. Liquidating versus non-liquidating partnership distributions. Which one allows a loss to be taken? Liquidating or non-liquidating? A loss on distribution can only occur in a liquidating distribution because, again, partnerships don't recognize a gain or loss on distribution. They can only do that if it's a liquidating distribution. This concludes Chapter 2.